So let's talk about gold and silver loans. The way you can borrow against your jewelry in India has just gone through a massive overhaul. The Reserve Bank of India, or RBI, has dropped a brand new comprehensive rulebook. And look, whether you're thinking about a gold loan or maybe you already have one, you absolutely need to know what's inside. So let's break down exactly what these changes mean for you.
I mean, if you've ever considered pledging your jewelry for a loan, or if you've got one out right now, this directly impacts your wallet and, honestly, your peace of mind. The whole point of what the RBI did was to shift the balance of power a little bit more back to you, the borrower. So the big question is, what are these powerful new rights?
All right, here's what we're going to walk through. We'll start with why these rules were needed in the first place. Then we'll cover the new basics of borrowing, how your stuff is valued and kept safe, what happens if things go south and an auction is needed, and most importantly, we'll wrap up with what this all means for your rights. So, first things first, why the big change? Well, for years, the rules around gold loans were, let's just say, a bit of a patchwork. It led to a lot of inconsistency and some pretty serious gaps when it came to protecting borrowers. And yeah, this slide really nails the whole before and after picture. We're moving away from this tangled web of different rules for different lenders to one single clear framework for everybody. The RBI's goal here is pretty simple. Make the process standard, make it fair, and bring a whole lot of much-needed transparency to an industry that, let's be honest, millions of people rely on. Okay, so with this new framework in place, let's get right down to it. What can you actually use for a loan under these new rules? And how much can you expect to get? The RBI is being really specific now. They've got a term for it, eligible collateral. And it strictly means jewelry, ornaments, or coins made of gold or silver that you're pledging for a loan. That's it. And just as important is what you can't use. Lenders are now officially forbidden from giving you a loan against things like a gold bar or a financial product like a gold ETF. Really, the idea here is to stop speculation and make sure the loan is based on a real, tangible asset that you clearly own. Okay, this brings us to a super important term you gotta know, the loan-to-value ratio, or LTV. Sounds technical, but it's really simple. It's just the maximum percentage of your jewelry's value that the lender is allowed to give you as a loan. Right, so that LTV ratio is based on what your gold is worth. But how is that value decided? This is where the new rules are bringing some serious fairness and clarity to the whole process. Now, this is a huge deal. Under the new rules, the value of your collateral is based only on the actual value of the metal itself, the weight and purity of the gold or silver. So any beautiful gems or stones you might have in that jewelry, unfortunately, they don't count towards the loan amount anymore. And to make sure everything is totally above board, you now have the right to a detailed certificate. The lender must give you a copy, and on it, it has to clearly spell out the purity, the gross weight, the net weight of the metal, any deductions, and even an image of the item. No more guesswork for you. And this table here lays out the new LTV limits for personal loans. As you can see, it's a tiered system. For smaller loans, up to 2.5 lakh rupees, you can get up to 85% of your gold's value. And then that percentage steps down just a little bit for the bigger loan amounts. It's a system that's really designed to balance the risk for everyone involved. So once you've handed over your precious jewelry, how do you know it's actually safe? Well, let's dig into the lender's new, much stricter responsibilities. This is a massive, massive shift. The new rules make it crystal clear. The lender, not you, is now fully and completely responsible for the safety and security of your pledged items from the second they take them. The buck stops with them, period. And this isn't just some vague promise. It's backed by very strict operational rules. Lenders have to store your valuables in a secure vault in their own branch, and it can only be handled by their own staff. They're even required to run surprise audits just to make sure everything is exactly where it's supposed to be. So what happens if they mess up? Well, the rules are very explicit. You get full compensation for any loss, full compensation for any weird discrepancy in the purity or quantity of the metal, and the lender has to pay for any repairs if your item gets damaged while it's in their care. And check this out. This is a real game changer. Once you've paid off your loan, if the lender drags their feet in returning your collateral for any reason on their end, they have to pay you a penalty of 5,000 rupees for every single day of delay. Now that is a very powerful incentive for them to act fast and get your stuff back to you. All right, let's talk about something nobody wants to happen, but we have to. defaulting on a loan. If it happens, the auction process that follows has always been a huge worry for borrowers. Well, the RBI has tackled this head-on.
This is all about making sure things are fair, even in a worst-case scenario. Lenders can't just have a fire sale and sell your valuables for a fraction of what they're worth anymore. The starting price for the auction, what they call the reserve price, must be set at a minimum of 90% of your collateral's current market value.
And the auction process itself is now standardized and transparent. First, the lender has to give you plenty of notice, giving you one last chance to settle up. If it still goes to auction, it has to be advertised widely. Then, after a transparent auction is held, here's the most important part. If the sale makes more money than what you owed, the lender is legally required to refund that extra cash to you within just 7 days.
Phew, we have covered a lot of ground. So let's boil it all down to the most important points. What are the key takeaways for you from all these new RBI rules?
You know, in a nutshell, these new rules really put you in the driver's seat. You now have the right to be there when your gold is valued and get that detailed certificate. The loan papers have to be clear and in a language you actually understand. You have a right to get your items back on time, a right to be fully compensated if anything goes wrong, and a right to a fair process if it ever comes to an auction. It is a massive leap forward for borrower protection. So we'll end with this question for you to think about. Now that the rules are clearer and your rights are so much stronger, has the RBI actually succeeded in making gold loans a more trustworthy and safer financial option for the average person? It's definitely something to consider.